welcome to India Decides, the FII View with me, Tanveer Gill. The series will put the spotlight on India over the near term, stepping into the all-important election event and also get views from foreign institutional investors of what they make of the India story given the global backdrop. Joining me on the show today is Ian Scott, who's head of global and European equity strategy at Barclays Investment Bank. Ian has more than 20 years' experience in the business of equities, and before joining Barclays, Ian was chief global equity strategist at Nomura and the erstwhile Lehman Brothers. Ian, it's great to have you on the show. Thanks very much for making the time to speak to us. First up, given that there's so much focus around elections and, that's the key event risk for India, what do you make of the rally in India at this point, which has taken the market to record highs? What is the market pricing in terms of a political outcome? A Modi-led government or a strong, stable coalition led by the BJP?
I think there are a few factors behind the rally that we've seen so far in Indian equities. Certainly, expectations regarding the upcoming election is part of the support, but we've also seen some important trade data which has been taken very well by both the stock market and the currency market. In addition, more recently, some of the economic news domestically in India has also started to improve. So I think those are the three elements behind the rally that we've seen in Indian stocks.
Right, yeah. Do you see a strong rebound in the currency as well, beyond 60? How much more upside do you see for the rupee?
Yeah, we do see upside for the rupee. We think the rupee against the dollar could hit 59 actually. Within a sort of monthly time horizon. So we do have quite a positive near-term outlook for the currency.
And in terms of just this rally that we've seen so far and actually are in the midst of, how healthy do you think the rally has been? FIIs have invested close to $1 billion, but domestic funds have not turned investors as yet.
Certainly the recovery in India has been predominantly driven by foreign investors. Inflows this year from foreigners have almost been matched by selling from domestic mutual funds. I don't think that means that the rally is somehow less important. I think the rally has taken place against the backdrop of poor returns in other emerging markets. So it makes the performance in India even more striking in my view.
Right. You have an overweight on India right now. In the current rally, which has been nearly 10% from the recent lows to record highs for the Indian markets, valuations have moved from 13 times 1 year forward to about 14 times 1 year forward. Traditionally, at 15 times 1 year forward earnings, foreign investors view India as entering the expensive zone, so to speak. How do you approach your India view post the recent rally?
I think the valuations on the Indian market at the moment are fine. Certainly, against the backdrop of the upcoming election, improving economic conditions, and also the scope for exports and foreign earnings to improve given the weakening in the rupee over the last few years. I think all of those things suggest that the current valuation is not really a constraint on further gains for the Indian market.
So what are you advising clients to do at this point? Are you advising them to put in more money into India or stay off for a bit given the risk in elections?
Our view on the Indian market is really two-pronged. With regards to the domestic index level, we are close to our target levels now following this recent rally. So the upside in the domestic index is relatively limited, we think. However, we also see a rally in the rupee over coming weeks and months. And so for international investors, we think there is still a strong attraction to investing in Indian equities.
But in lieu of the upside that the market is likely to see potentially going forward, what kind of returns are you expecting from the Indian market, also accounting for a possible currency benefit from these levels?
Well, I think the combination of the domestic equity performance and a recovery in the currency, should lead to, healthy outperformance for Indian equities over the balance of this year.
You're betting on export recovery in India. Exports so far have not taken off, so to speak, for the Indian economy. There has been some compression in imports, which is reflected in the trade data. What kind of export growth are you then expecting going forward?
We do expect exports to recover. I think the first impact of the decline in the rupee that we've seen has been really through import substitution. And that's really helped on the trade side. So that's the first effect that we've seen. I think from for the medium term, we think export volumes themselves will pick up, and that should further improve the current account and support the rupee.
Now, your focus on IT is fair. The stocks have done well there, but the leader from the sector, that's Infosys, has accepted that there are concerns over growth. What is the view on IT, and does it still look attractive to you?
We think IT as a sector is an attractive place to be. Certainly on a global basis, it's one of the strongest performers this year, and we think that's justified. The growth that continues in the sector doesn't, to us, seem to be reflected in valuations, and we think that that is also evident in some of the leading companies in India.
But what about the view on PSU banks? Do you see that changing? NPAs are being packaged and sold to asset reconstruction companies, and that seems like a trend in the making. There is value support coming in, given that these banks are trading very cheap, and the expectation is that asset quality will not deteriorate further. Enough reason to look at these banks favorably at this point, you think?
We have a rather cautious view on the bank sector in India. I think certainly the expectation is that non-performing assets will increase over time, and given the favourable impact of the weakening rupee on some of the export-orientated sectors, we would prefer to invest in those areas rather than the financials.
Right, we are seeing interest in state-run companies. Is this a trading bounce ahead of elections, or with the new government, these policy-sensitive stocks make a case for a possible structural makeover, so to speak?
I think with the state-owned enterprises, we probably want to wait and see. The election clearly has built up some expectation ahead of that, and over coming months, we want to wait and see just how important some of the changes are going to be for state-owned enterprises.
All right, now let's discuss your EM outlook a bit. Just stepping back and putting India viewing India in the broader EM basket. You have stated that the recent underperformance in emerging markets is not Fed-induced, or liquidity-induced rather, but more growth disappointment. When do you see or expect a turn in the cycle then?
The overall performance of emerging market equities has been poor this year, and I think the reasons for that are mainly due to concerns about global growth, and in particular growth in China. The earnings estimates for emerging market companies have been cut more than any other region, and that's been reflected in the underperformance of the shares. I think as we look forward to 2014, we still remain confident that global growth will accelerate this year. 3.4% is our forecast, and I think over time that will start to feed through into some better earnings for emerging market-based companies. A number of countries have benefited from lower exchange rates, and that really ought to boost their exports. So we do remain encouraged despite the poor start to the year.
So are emerging markets over the last week or two showing signs of a structural rebound, or is it, again, one of those relief rallies, trading rallies like the one that we saw in October, November of last year?
I think the performance of emerging market currencies and equities has been very interesting in the last few days, with the US stock market and other developed markets such as the Japanese market, falling relatively sharply. We really haven't seen contagion in emerging markets. And I think that is an indication that many investors have already sold their exposure, and we can certainly see in terms of the outflows from EM equity funds that there has already been something of a capitulation. So I think the resilience recently is a good sign for emerging market equities.
Right. Now, Ian, you really like China. You think the market looks remarkably attractive. Is this a view despite the fact that the recent data has confirmed that the market or the economy actually is going through a slowdown?
I think the Chinese economy is still a major source of uncertainty for investors. However, I don't think we should lose sight of the fact that growth expectations for the Chinese economy have come down tremendously over the last few years, from about 9% to 7%, and I think on a sort of quarterly basis we may be down to 5%, in the first quarter of this year. So a lot of that growth slowdown has already taken place and is already in front of investors. So our expectation is that the first quarter will be the worst, and that Chinese economic growth will improve from Q1. And with the stock market looking very cheap indeed, we think that shares there will perform well over the balance of the year.
Also, Russia is an attractive market for you. How do you see the geopolitical tension coming out of Ukraine impacting that view?
I think Russia is, a huge source of uncertainty. Clearly, we still don't know how the crisis is going to end. And in the center of a crisis like this, it's probably unhelpful to make strong statements about the future direction of that stock market. The ultimate outcome, will obviously determine the performance of the Russian equity market, but I think people should realize just how cheaply priced it is at the moment. So the PE and the dividend yield are both almost the same at about 4. And we think as long as the crisis does not accelerate from where we are at the moment, then probably Russian stock market will recover. But clearly at this point it's too uncertain really to hold a view on that.
Well, what is your outlook on emerging market currencies? You've given your view on the rupee, which is bullish, but do you think that emerging market currencies as a whole, as a basket, could they rebound from here?
We think EM currencies might do a little better than many people expect. Firstly, the central banks of several vulnerable emerging countries have raised interest rates, and that action has been successful in stemming the declines in their currencies. Secondly, if we are right that the global economic recovery continues in 2014, emerging economies should benefit from that in terms of export performance. So that should be helpful for their currencies. So our sense would be, on a selective basis, that there is value, and we would expect to see some recovery in emerging market currencies.
And as per the earnings yield gap that you highlighted in your report, you believe emerging markets can outperform developed markets over the next 12 months by 12%. What will lead this recovery in growth, as most emerging markets are seeing a higher rate environment and relatively stubborn inflation still? Cost controls can expand earnings, which we've seen over the last 2 quarters, especially in India. But when do you see revenue growth kick in?
I think the key for the outlook for emerging equity markets is their export performance. Historically, earnings of emerging market companies have been very closely associated with export growth, and we've seen a period of very slow and poor export performance. So that can explain why things have been difficult recently. But going forward, we've got a number of currencies that have declined sharply, and that will help competitiveness. And secondly, with the global economic recovery unfolding through 2014, that really ought to help EM export growth and therefore emerging market companies' earnings.
Okay, just stepping back a bit and getting a sense of what's happening in the US right now, how do you view the Fed policy action from here on?
The Federal Reserve have been very careful in communicating their tapering of quantitative easing. We think that tapering will continue through to the autumn of this year, when they'll stop the QE program. So that to us represents a very gentle reduction in the huge degree of stimulus being applied to the US economy. On our forecasts, that will not undermine the growth outlook for the US, and accordingly, we don't think that's going to undermine the outlook for US equities. However, having said that, we do see the best returns coming from non-US stocks.
There has been some talk, no confirmation coming in on this, but just some trader talk, some market talk about how large billionaire investors in the US are reducing their stock holdings or cutting back on their market exposure. Is that a sign somewhat to doubt the US market rally? Do you think that there has been an overflow of optimism that might correct itself going forward?
I think when we look at the US, there is a high degree of bullishness at the moment, and I think that does make the market vulnerable to short-term corrections. We've seen really since the financial crisis in 2008 that sentiment has played a very central role, much more important than it has previously, in the formation of stock prices in the US. And if that's right, then this current bullish sentiment is a threat to the near-term outlook. That said, we don't think the bull market is coming to an end. Fundamentals remain good in our view, and therefore that highly bullish sentiment really is a reason to expect short-term corrections rather than a major turn.
All right, Ian, we really appreciate you taking out the time and speaking with us today, giving us your India view as well as your EM outlook going forward. Really appreciate your time as always. With that, we come to the end of this edition of India Decides, the FII View. Catch you with another special guest next week. Till then, we leave you with a slice of market opinion on how the India story looks from here, given that the market has hit record highs.
For now, we're very happy to maintain our overweight in India. You highlighted earlier the situation with the election, and I think the market will continue to price in a change in government, and that'll be positive for the market. The currency looks very comfortable, and with problems in Crimea making Russia unattractive and Turkey and arguably CE3, plus concerns about Chinese economic growth, then I think India remains a very interesting exposure for emerging market investors. We've been pleasantly surprised by the move that's occurred in the rupee. We're probably more comfortable with it around the 62 level, but it is quite possible that it could breach 60. We are overweight both private and PSU banks, with the view that concerns on asset quality will be diminishing if we are correct that economic growth does begin to pick up. So it remains another cyclical play on the Indian economy. If we have a more pragmatic, decision-focused government, then the state-owned enterprises or public sector units, as we call them in India, may favor or may be more in favor than they have been.
It seems to be that investors are starting to, largely discount a victory by the BJP and in particular Mr. Modi in the upcoming election. So yes, given the very sharp rally we've seen in the equity market and the rebound in the currency, we believe that market expectations are very high that Mr. Modi will come in probably with the support of a coalition government. We've had a very sharp appreciation of the rupee from those record lows of around 67, 68 versus the dollar back in September last year. So we at that time did feel that the rupee had overshot on the downside. We feel now that it's pretty much back to kind of fair value or probably slightly kind of has appreciated a little bit more than what we thought it would. But we think the rupee should probably settle around this level now. For the key overweights we own in India, companies like HDFC Bank, TCS, ITC, we still see upside and are continue to be happy holders of those types of companies.
We will see further tapering in line with 10 billion reduction in large-scale asset purchases, treasuries and mortgage-backed securities. And the Fed will continue its course because the labour market is showing some signs of tightening and the numbers are improving. So the underlying trend in the US economy is still about 3% in our opinion. I think Modi is obviously a very big influence on the stock market, and whether that is now basically in the price, I suspect as the election draws near, it will actually run a little bit further. Clearly, investors are really hoping that there will be a change in government in India and a more business-friendly, reform-minded administration led by a BJP coalition. That is the dream outcome for investors, both domestic and foreign.